All right, let's get right into it. Welcome to this explainer where we're digging into some seriously fascinating source material. Today, we're looking at what is essentially the ultimate chronological blueprint for allocating your paycheck in 2026. If you've ever stared at your bank account on payday and wondered exactly where every single dollar should go to absolutely maximize your wealth, well, you're in the right place. We're going to explore how this flowchart maps out a cascading, step-by-step strategy to optimize your money. Okay, let's dive into this, because the huge issue driving this whole new playbook is inflation, right? The reality we're all facing is that everything, from rent to groceries to your utility bills, costs about 30% more than it did just 3 years ago. 30%. Inflation has fundamentally changed the math of our daily lives. So you add that up with lower high-yield interest rates and the newly increased contribution limits for retirement accounts, and it becomes crystal clear why the old financial advice really needs a massive refresh. What we're looking at today is a routine built specifically for the reality of 2026. To tackle all this, the source material breaks the flowchart down into 6 sections. 1. The setup, automate and protect. 2. The baseline, budget and emergencies. 3. The match, free retirement money. 4. The debt, avalanche versus snowball. 5. The growth, advanced investing strategies. And 6. The defense, multiple income streams. We're basically going to follow a single dollar as it pours down through these exact steps. Starting right at the top of the waterfall with Section 1, the setup, automate and protect. So the absolute first place your money has to go the very second it hits your bank account is simply treading water. By that, I mean paying the bare minimums on all your debt. Credit cards, student loans, auto loans, those minimums have to be met. Why? Because missing just one single payment will completely tank your credit score. Payment history and the amount owed make up a massive 65% of your score. It's a huge chunk. And if that score drops, getting an apartment or a decent mortgage rate becomes, well, incredibly difficult. So step 1 is just pure defense. The source material refers to this next part as step 1.5, and honestly, it's a real game changer. The secret sauce here is realizing the tension between human psychology and math. Relying on pure willpower every single month, it's a losing battle. But by automating everything and setting up automatic transfers, you literally remove yourself and your willpower from the equation entirely. The money just moves before you even see it sitting in your checking account. As the material points out, you simply can't spend money you don't even have. That flows right into Section 2, the baseline, budget and emergencies. Now your money fills up your monthly operating budget for daily necessities: rent, utilities, food, transportation, the whole shebang. The classic 50-30-20 rule is a great baseline target here. That's 50% for needs, 30% for wants, and 20% for savings and investments. But let's be real for a second. If you live in a high cost of living area, that needs bucket might realistically push closer to 60%. And that's okay. The key takeaway is to run your own personal numbers and make sure this operating account always has enough to cover exactly 1 month's expenses, plus a little bit of a buffer. Now, totally separate from that operating budget is your emergency fund. Back in 2023 and 2024, high-yield savings accounts were paying out a really nice 4 to 5%. But for 2026, those rates have cooled down to around 3.25%. Even with that drop, though, it's absolutely still the optimal place to park your emergency cash so it stays liquid. Because of modern economic volatility, the source suggests aiming for a 4 to 6 month buffer now instead of the old standard of just 3 months. To put that into perspective, if your needs are $2,500 a month, your target is a $10,000 to $15,000 baseline before you even think about moving to the next step. Let's keep the money flowing into Section 3, the match, free retirement money. The flowchart directs your funds next into an employer retirement account. So think of 401k in the US or workplace pension in the UK. With the 2026 limits sitting at $24,500 for anyone under 50 and $32,500 if you're 50 or older, the strategy here is super straightforward. Just contribute whatever percentage is necessary to secure your full employer match. Literally, do not leave this on the table. It is mathematically free money. The real secret here is boring consistency. Just automated, boring consistency. Let's say you automate a 10% contribution, around $7,500 a year, into an S&P 500 index fund for 40 years, assuming an average 8% return. That mathematically builds a staggering $2.1 million. It's not magic. No way. It's just compounding interest doing all the heavy lifting for you while you sleep. Moving down the waterfall to Section 4, the debt, avalanche versus snowball. Now, what's really interesting here is how we attack any remaining high-interest debt, specifically anything over 15%, like a credit card. The source outlines two distinct methods. First, there's the avalanche method. This is mathematically optimal because you target the absolute highest interest rate first. But then there's the snowball method, which is psychologically optimal. You pay off the smallest balance first to get a quick win and build momentum. So it really just comes down to knowing yourself. Are you a strict math person, or do you need that emotional momentum to stay on track? So what does this all mean for the gray area? Lower interest debt in that 4 to 6% zone, like student loans. Should you pay that off before moving to the investment steps? Well, the math says you can typically make 8 to 10% in the stock market, meaning investing is technically worth more over time. But paying off a 4% loan guarantees a 4% return on your money. And honestly, it provides immense peace of mind. Again, it's about choosing the path that lets you sleep best at night.
Okay, Section 5, the growth, advanced investing strategies.
For whatever money is left over after basics, emergencies, and that employer match are handled, we finally enter the advanced investing tier. Here is the exact order of operations to optimize your tax advantages. Step 1, you've already done it. The 401k match is totally secure. Step 2 is taking the remaining cash and maxing out a Roth IRA. And if you somehow still have funds left over, Step 3 is to top up that 401k to its absolute maximum limit or open a standard taxable brokerage account. When you're deciding between these accounts, the whole strategy comes down to tax treatment. The Roth IRA gives you tax-free growth, making it the perfect vessel for high-growth ETFs to really maximize your upside. Just keep in mind that 2026 limit of $7,500. On the flip side, the taxable brokerage doesn't have contribution limits or age penalties, but you will pay capital gains taxes on your profits. So that makes it much better suited for highly reliable, low-turnover index funds.
But hey, if you were using that taxable brokerage, beware of the short-term tax trap. It's a big one. Selling an asset for a profit within the same year triggers ordinary income rates. That means you could potentially get hit with a massive tax penalty of up to 37%. But if you just hold that exact same asset for a year and a day, you unlock long-term capital gains, which drops that rate all the way down to between 0 and 20%. Bottom line, the IRS rewards patience.
Finally, we reach Section 6, the defense, multiple income streams.
Look, with massive AI disruption completely shifting the modern economic landscape and tech layoffs constantly making headlines, relying on a single source of income is honestly a massive liability. But building a defense doesn't mean you need to grind 80 hours a week. Dedicating just 1 to 5 hours a week to freelancing, dividend investing, building up a content channel, or opening an online store, that can realistically generate an extra $500 to $1,000 a month to diversify your risk. And this right here is the absolute beauty of the waterfall method. It is a closed-loop system. When you generate that new side income, it immediately flows right back up to the top of the flowchart. It seamlessly fills any gaps in an emergency fund, it maxes out your Roth IRA way faster, and it pours right into a taxable brokerage account. It dramatically accelerates your entire compounding machine. If Step 6 sounds like maybe a bit of overkill to you, consider this pretty wild statistic from Inc.com. 65% of self-made millionaires have at least 3 streams of income. Having side income isn't just a nice little bonus anymore. It's a vital, proven characteristic of modern wealth building. It acts as the ultimate defense mechanism for your entire financial flowchart. So you've mapped out exactly how to automate, protect, and grow your primary paycheck based on this 2026 blueprint. But what is your plan to build income stream number 2? Think about it. Thanks so much for joining me for this explainer on the 2026 Wealth Flowchart. Keep optimizing, and I'll see you in the next one.